Buying an expensive piece of equipment for your business is only the first step. Every single day that truck is out on the road, it loses value. It is silently being used up. If you fail to track that physical wear and tear on your company's books, your financial records will drift away from reality, leading to significant accounting errors. By the end of this video, you will be able to build a complete multi-year depreciation schedule and choose the specific calculation method that fits your equipment. To follow along, you will need the total purchase price of your asset, an estimate of what you can sell it for at the end of its life, and a calculator. Mastering this process replaces guesswork with a clear, mathematically sound financial strategy. Before we choose a calculation method, we have to lock in 4 core numbers. Look at the list on the right. First is the original cost, represented by the letter C. This is the total price paid to acquire the asset. Next is the salvage value, or S. This is the estimated residual value. Then we have the useful life, or L. This is the estimated operational time period. Finally, the most dynamic variable, net book value. This is the original cost minus accumulated depreciation. These 4 variables act as the financial DNA for your asset. With our variables set, we can start with the straight line method. This is the simplest approach, used for assets that lose their value at a steady, constant rate. This diagram shows the core formula. The most common error here is forgetting to subtract the salvage value from the original cost before you divide by the useful life. Let's apply this formula to a delivery truck purchased for $50,000 with a $5,000 salvage value and a 5-year useful life. We subtract the $5,000 from the $50,000 to find our depreciable base, then divide that base by 5. That results in an annual expense of $9,000. Every year, the company records this $9,000 depreciation expense, which reduces the net book value. At the end of year 5, the net book value matches the initial $5,000 salvage value, creating a mathematically closed loop. For assets like technology that lose a majority of their value early in their lifespan, we use the reducing balance method. Look at this ledger. We are calculating the year 1 expense for a $20,000 server farm with a 40% depreciation rate. 40% of $20,000 is $8,000. The net book value drops to $12,000. In year 2, you must multiply your rate by this current net book value. Do not use the original cost again. 40% of $12,000 gives us a $4,800 expense for year 2. Our net book value drops to $7,200. By year 3, the annual expense shrinks further to $2,880. Observe one hard stop rule. Stop depreciation the moment net book value hits your predetermined salvage value, regardless of the formula. This front-loaded method mirrors technology's rapid obsolescence, keeping the balance sheet grounded in market reality. The final approach is the machine hour or unit rate method. This discards the passage of time and ties depreciation directly to physical production. As you can see in this comparison, this requires a 2-step formula. First, find the fixed cost per unit of use. Then, multiply that rate by the actual hours run or units produced during the accounting period. This provides financial protection. If a factory shuts down and a machine produces nothing, the depreciation expense for that period drops to 0. With 3 different calculation methods available, how do you choose the right one for your specific asset? This matrix maps out the ideal categories. Use straight line for buildings and office furniture. Choose reducing balance for tech hardware and software. Apply the unit rate method to heavy factory equipment and commercial aircraft. This ensures a precise financial record of your physical resources. You have now converted raw business costs into a structured, multi-year depreciation schedule. You possess the framework to justify your chosen accounting method to stakeholders or auditors. Click the link below to use our interactive widget. This visualizes the differences between these methods over an asset's lifespan. Accounting for asset depreciation protects a company's bottom line by keeping the balance sheet aligned with physical reality.